Okay, so let's discuss the business model of KIMS Hospital. So KIMS Hospital is a hospital chain with almost 5,000 beds. Interesting thing to note here is that out of all the hospitals I have looked at, KIMS has most aggressive expansion plans. So we can say in a way it has highest upside in revenue and EBITDA from here, which I think is visible in its valuation ratios as well, which we will discuss further. Now coming to geographic concentration, so this company's 90% of the revenues come from South, out of which 54% of the revenues are coming from Telangana and Hyderabad. Now, now management is aggressively trying to expand its portfolio in other cities like Maharashtra, where they have come up with a 334 bed capacity hospital in Nagpur. Now, the total capacity in Maharashtra is expected to reach 1,300 beds, close to 15% of the total capacity. Unlike Apollo, it is a pure play hospital chain business. Now coming to the one key concept, average revenue per operating bed. Like any other hospital, this is a key metric for KIMS as well. Now the company is aggressively expanding its average revenue per operating bed, but it has a way lower RPOP versus someone like Apollo. So Apollo has RPOP close to 70,000 versus this company, which has a RPOP of close to 40,000. The major reason for this is KIMS heavy presence in the tier 2 cities. So of course, tier 2 cities have way lower cost of treatment versus a tier 1 metro city like a Bangalore or a Mumbai. So this is visible in KIMS number as well. So if we look at KIMS RPOP for Telangana, it is close to 60,000 versus Andhra Pradesh where it is close to 20,000. So if you are looking for a cheaper treatment, I think you should consider shifting to a tier 2 city. Okay, so now moving forward, I'll talk about the financial highlights next. So post-COVID, revenue has increased 3 times, which implies a CAGR of 28%. But the thing to note here is that it is not all organic. Company has been doing aggressive expansion since post-COVID. It has expanded its bed capacity from 3,000 to 4,000 by end of March 2025. Now, what happens during expansion is hospital keeps on adding beds. COVID revenue has become 3 times, which implies a CAGR of 28%. But the thing to note here is that it is not all organic. Company has been doing aggressive capex plan, so it had expanded its bed capacity from 3,000 in March 21 to 4,000 beds by March of 2025. Now, what happens during expansion is hospital beds keep on adding. So as the number of hospitals keep on increasing, it takes a hit on margins. As during this growth phase, new hospitals keep on coming, meaning increased management cost, employee cost, doctor fees, but patients come with a lag. It takes 9 to 12 months for a hospital to become EBITDA positive. Another thing which has happened with KIMS is that to fund this aggressive expansion, they have aggressively taken on debt. So the debt has crossed like more than 2,000 crores. So talking about the future growth. So to understand the future growth, let's talk about how hospital businesses grow. Just like any other business, growth comes from two parts, price and volume. Now, price in this case is like when a person visits a hospital, they pay for like their treatment. Now there are multiple types of beds in a hospital, and also every patient stays for different number of days. That's why we use average revenue per operating bed and then multiply it by 365 to come at a revenue from a bed for the year. But of course, not all bed is occupied for the whole year. That's why management reports occupancy rates, which simply means out of all the available beds, how many beds were occupied if we see on annual basis. This adjusted number is simply our volume. Now, price rises annually in line with inflation, or people say healthcare inflation is higher, so maybe a little higher than inflation. Another way price may rise is company starts doing more complex procedures which are charged higher rates. Volume can rise by two ways. Number one, the occupancy rates rises. Here what happens is when a new hospital opens, it doesn't get busy with patients from day one. Just like any other business, it takes time to get on track, and once it matures, its occupancy rate stabilizes generally around 60 to 80% range. Number two, and more impactful, is when you expand. So when you open new hospitals, which is called greenfield capex, or expand existing hospitals by adding a new building to it or a new floor to it, which is called as brownfield capex, it leads to more bed capacity, which leads to more patients coming in, which in turn leads to more volume coming in. In case of KIMS, what's happening is that they are aggressively adding bed capacity. To give some perspective, KIMS had 3,200 beds pre-COVID, and they're expected to exceed 9,000 beds by end of 2029. That's 3 times capacity addition in a decade, and a lot of it has happened in 2025, or it is going to happen in 2026 to 2029. This way, you can think what kind of revenue and EPS growth KIMS is going to witness. Now, coming to a very important part, which is a very key element of decision making, but a lot of retail investors miss, is valuation. So, coming to valuation, so see, it is a asset heavy business. So, we should use EV by EBITDA as our valuation metric. Now, currently it trades at a EV to EBITDA multiple of close to 35x, which is on higher side if you look at general multiples of hospital stocks. So in 5 years, when most of the capex is over, this business should trade at normalized multiples of 30x. Now this multiplied by EBITDA and at end of 5 years, which is my number, which if I run my numbers comes close to 18,000, the CAGR return we can expect is 14% for this stock. So concluding, so combining all of this together, KIMS is a hospital chain with above industry growth expectations led by expansion, which will increase its bed capacity 3 times from pre-COVID levels and 50% from current levels. Also, the company has moat in the sense that it has a leadership in South India and it is also a leader in tier 2 markets. But this is also a risk in terms of geographic concentration. Another risk to highlight is that it has a leverage of more than 2 times as of today. Also, when we ran our numbers, there doesn't seem to have a lot of headroom left for growth. With our expectation of a 14% return CAGR over next 5 years, I don't think it is justified for the risk we are taking. So just to sum it up, the risk we are taking include execution risk, which basically means that as I told, the company is expanding aggressively. So there might be issues that come up during the expansion. There might be debt issues, or there might be regulatory issues, or there might be delays. So that is one of the risks we are taking. Another risk which we are taking is the leverage risk. So the company, as I told, has leverage of more than 2 times. So if situations get worse, like 2-3 quarters, there is not enough business or the interest costs rise, so this company might get in financial trouble. Another risk to note is geographic concentration risk. So as I told that this company is heavily focused on south of India. So if some issues come which are inherent to south of India, then this company will feel more pressure versus Apollo, which has a pan-India presence. Another risk I would highlight is that there is always an inherent regulatory risk in healthcare sector. Also, one of the risks is overcapacity risk. So as all of the hospital chains are doing aggressive expansion, there is a chance that there becomes overcapacity in key markets, which will lead to cannibalization and lower occupancy for all the hospitals. So for summing it all, I don't think the return which is expected to get from this stock is worth the risk we are taking. So for me, it is a avoid.